Bloomberg Audio Studios.
Podcasts, radio, news.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
An M&A trade might be on the blocks, or on the rocks here. Anglo American rebuffed a sweetened takeover offer from BHP Group that valued it at about $43 billion US, leaving it up to the Australian miner to make a better bid or lose out on what could be the industry's biggest deal in a decade. Let's bring in an expert on this stuff. Alon Olsha, Bloomberg Intelligence Senior Metals and Mining Analyst. He joins us from London. I did not hire him. He's a recent
okay,
hire,
good to know. It's important.
We'll check him out here. Alon, what do you got for us? What's going on in the global mining space these days with these names?
Looking for copper is the most coveted metal out there in the mining industry. It's in short supply. It's expensive to build new mines. It's risky to build new mines, and demand is set to climb significantly because of applications around the energy transition. So miners are looking for opportunities to grow exposure, and that's one of the main reasons BHP's gone after Anglo American, which Anglo American's been around for a while. They got a bunch of assets in there, not just copper, but it's always been a difficult business to buy because there's some assets in there that are problematic, that are unwanted. They've effectively served as poison pills for a takeover. But BHP's now come with this bid. It's structured in an interesting way. They're basically saying, we'll buy you, but you need to demerge some of your South African assets, spin them off to your shareholders, and we'll pick up the rest.
And that therein lies the problem. Like, that's why no one really wants that for Anglo American, right? Because they're saying, you go spin this off, then we'll buy the rest of your company. Why don't they just buy the whole company and then sell it off?
Yeah, you're absolutely right. It's one of the reasons shareholders don't seem to like it. It's a complicated structure. It basically introduces a whole lot of risk for those shareholders that'll be inheriting these assets, execution risk, value risk. But for BHP, it's also a headache that they don't want to absorb themselves. They don't want to take it on. They effectively would be taking on potentially the value trap that has been plaguing Anglo American for so many years. So, and remember, BHP kind of has withdrawn from South Africa. BHP was, until not so recently, BHP Billiton, and that was an acquisition of a merger with a business that had a huge South African presence, and then they spun it off in South 32. So there goes a South African asset. So they don't really want to be there, and it's kind of understandable. South Africa is a difficult place to operate at the moment.
But you're South African.
So for them,
you're South African.
Well, I know. I do feel bad saying it, but it's the truth. It's the truth, and we speak the truth in Bloomberg Intelligence.
There you go.
Nice one.
So I think it's a tough one for them to get their head around.
I think that, in essence, what this just also boils down to is the money made in discovering new copper assets is minimal. Like, the hurdle rate's really high. So the way to do that is you have to buy competitors. It's very difficult to get the kind of scale. Right? Building a mine's really hard. There are a lot of different labor laws in different countries. Look what happened in South America, while all of a sudden, like, mining just was like, no, what, we're good. Like, you can't take any copper out of here. I think that was in Peru. Does that just speak to that problem? And what's the other solution to that? The geopolitical risk premium for copper is a very different proposition than I feel like it's been in the last few decades.
Yeah, that's absolutely right. I mean, geopolitics has made things more difficult, but it's not really new. It's been a bit of a slow burn issue. It's also, the reality is, geologically, it's tough to find the deposits that are close to surface in really high grades, and those deposits tend not to be in the US or Australia. They tend to be in some tougher jurisdictions like the Congo, the DRC, or in Argentina, which is politically seems to be always in flux. So if you want to go after these assets, you want to build exposure and build these mines, you need to take on that risk. And as you say, the hurdle rate is very high. And at current copper prices, it probably starts to make sense. But just a few months ago, before kind of the resurgence we'd seen when copper was trading, $8,500 a ton, miners just couldn't make the economics work. Now it's a little bit easier at close to $10,000 a ton, but even still then there's questions as to how sustainable that price is in the near term.
So, Alon, I'm just putting on my investment banker cap here. I think Anglo American's got a great position. They don't have to do anything, and they don't. If I were them, I'd be like, no, if you guys want us, buy the whole thing, and then you deal with it. Pay me a premium, or I'll just stay with my copper here. I mean, there's really no reason for Anglo to cave in here, right?
Yeah, that seems to be the way they're going for the time being, but there is a lot of pressure on Anglo American. So at the end of last year, they came out with an investor update. Anglo American, before the end of last year, before December, was the go-to play in the mining space for growth. They had a great growth profile. They had good projects. They had been investing through the cycle, so growth was coming in at the right point in the cycle when most of their peers had pulled back and had a bit of a growth gap. Then came December last year, investor update, and they slashed guidance across the board. Share price was decimated, and that's why we're in the position that we're in now. And it's shaken the credibility, it's shaken the confidence of investors in the credibility of management. So, yes, they can reject this bid, but the onus is then to come up with a credible strategy to unlock the value in the stock, and that's probably actually going to happen tomorrow in some way, shape, or form, where they said they are coming out with their standalone strategy. So that'll be really interesting to watch.
All right, we'll circle back with you and see what the market thinks about that. Alon Olsha, he's a senior metals and mining analyst at Bloomberg Intelligence in London, the pride of South Africa. Although it's tough to be a miner in South. I didn't know you knew all about the mining stuff too. You're just like the global energy space.
You didn't know that?
No.
I can explain you that too, for sure. I started in gold.
You started in gold.
Then I went to copper. Then I went to oil.
All right, very good stuff. You learn stuff every day here.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
The other big story that we're following, as Paul alluded to, happy Monday, everybody, by the way, is Bill Hwang's trial on Archegos Capital Management. The real issue, of course, is that the accusation that what the prosecutors are looking at is if he actively lied to the banks that were helping him fund these swaps to bet on basically 10 stocks that came spectacularly crashing down on him in the last few years. Sonali Basak is Bloomberg Television Anchor, and she is joining us outside the New York City Federal District Courthouse. Sonali, what's at stake in this trial?
Well, there's a lot at stake for Bill Hwang and, of course, his chief financial officer, Patrick Halligan, who were being accused here by regulators and, of course, the Justice Department of manipulating the markets, of racketeering. Wires fraud and securities fraud are, in particular, the charges that they're facing. They could face significant jail time, depending on how this trial goes. Of course, they are planning to defend themselves quite vigorously here. But there's also what happened, right? We know a lot about what happened in the sense of the banks had lost billions of dollars off the heels of this, Alix. But remember, as a family office, there was not required by means of disclosure for Archegos and Bill Hwang. In the initial indictment, you did see prosecutors nod to that fact, but said they did lie to the banks and indeed attempt to manipulate the market. So it will be a trial unlike we've really seen before in the world of white-collar crime.
Sonali, the best I can tell from just reading into this story is that Mr. Hwang's defense is basically, hey, I'm not responsible for the other side's losses here. They're big boys too. Does that have merit?
That is a fair assessment here. If you think about Credit Suisse in its own right, this is not the only place they've lost significant money tied to a client. You have the banks saying that they were lied to, but you have Bill Hwang saying, well, okay, his defense might bring up Credit Suisse's own risk management report outlining its own failures in risk management at this point in time. So we can see that scuffle between the banks and Bill Hwang's defense come up in the course of this trial.
Yeah, see, I think that's so interesting because it really is about the banks helping Viacom CBS issue the shares, right? That's one part of investment banking that led to the sell-off, that led to the margin calls, that led to all of this unraveling. So it's like the two sides shouldn't talk to each other, the ones that are working with Bill Hwang and the ones that are helping Viacom CBS issue shares. But in this case, they probably should have been able to talk to each other to see what each other was doing.
Yeah, let's go back and talk a little bit about what prompted all of this. It's the idea that he became a family office with an expected $1.5 billion in capital to more than $35 billion in capital in a very short amount of time. And the reason he was able to amass these massive positions was really buying a lot of these shares on swap agreements. And what happened was he had amassed a size so sizable in Viacom CBS that when the banks went on behalf of the company to try to offload or sell more shares on behalf of Viacom, that's when that created pressure on the shares. That's when the banks started to really look at Archegos, how much they were holding, their exposures, and the need for potential margin calls. Interestingly, on Monday, after those opening arguments, we may hear from the first witness for this trial, and it may be a counterparty at UBS that was behind one of those first early calls that really talked through those margin calls and how quickly Archegos would be able to put those up. So what do they know and not know? What do they need to know? And what do they need to know by law? I think that that's the critical part of this discussion here.
Hey, Sonali, just real quickly, what's the timing here? How long will this trial, how long is it expected to last?
It will be weeks. It will be a number of weeks. We are expected to hear not only from two of his former employees, remember two of them also already pled guilty, but there could be a list of more than 24 people from counterparties, these banks, that might step forward in the wake of this trial, in the course of this trial.
All right, Sonali Basak, thank you so much for joining us. Sonali Basak, she's downtown at the courthouse. Archegos Capital trial starting today. Could take several weeks. Big dollars involved. A lot of big, important investment banks involved here, but this was certainly the news of,
oh my gosh, it was spectacular.
Yeah,
and I've never seen anything like that before in many ways.
And of course, the biggest manifestation is it just contributed, didn't cause, but it contributed to the demise of Credit Suisse, my former employer.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
I'm Alix Steele, alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We cover all the top news in finance and economics with our analysts worldwide. They cover 2,000 companies in 130 industries. We also get the best and the brightest to come into the Bloomberg studio on a Monday and give us their take on the markets. And for that, we go to Dryden Pence, CIO at Pence Wealth Management. Now, typically, Dryden, you're in California.
That's correct.
So, why are you here? This is not fun for you. Good for us.
Well, every now I come to New York about once a quarter. We have a lot of folks in this area, and so it's good to come here. So I'm really happy to be here today. Thank you for having me.
We welcomed you yesterday with rain and coldness, so you're welcome on that point. So there was a great piece in the Bloomberg that talked about how S&P 500 companies are on track to post their best quarterly earnings relative to expectations in at least 2 years because nothing disastrous happened. We didn't get that recession. And this dovetails with your note saying that this year has been much ado about nothing.
It is. I mean, people kind of dance on the head of the Fed's pen, but I mean, the point is that if you look at basic earnings, we're probably going to have record earnings across the S&P 500, and we started off with the Magnificent Seven leading the market, but now the rest of them are beginning to catch up, and I think that we're going to see this 493 continue to spread out and go, and that earnings are going to. It's basically the beat goes on every time we come. The beat goes on.
What's the pin on your lapel? The people on radio can't see it, but what's the pin on your lapel?
That's a Bronze Star.
Bronze Star, U.S. Army.
That's correct.
Thank you for your service, my friend.
Thank you for paying your taxes.
Yeah, exactly. That's what I'm good at. You don't want me in a foxhole. You want me writing a check.
You will write those checks.
That's how I
good
can
at
help
it.
out.
Hey, you buy body armor, and that saves soldiers' lives. So thank you very much.
All right. Talk to us about this earnings cycle. We're just kind of getting through. We'll hear from some of the retailers here. Anything that kind of knocked you off your game one way or the other from this earnings cycle?
Well, in the earnings cycle, of course, we've got Walmart coming up at the end of the week here. But I think that what we're seeing is that consumers are continuing to spend. and that's beginning to transfer into earnings. Everybody, lowered their expectations and kind of put them down, and so we're coming in this thing. It's an easy beat cycle, and we continue to do that. But wages are at an all-time high. Earnings are at an all-time high. We've got more people working than ever before, and that drives consumers. And if you give an American consumer money, they're going to spend it. So I think that we're continuing to see that across retail. We're continuing to see that, but people break up. You have a certain amount of trade downs. When we mentioned the Walmart piece of it, is that the largest, fastest growing group of Walmart shoppers are folks that make over $100,000 a year.
Really?
And
okay.
And then they get in there. They get in there because they come for groceries. Inflation has kicked up groceries quite a bit. People feel that. They go in, and then so there really is an opportunity for continued increase in market share. And so you kind of get then you get the aspirational side because you have the very high end is doing well. I mean, gosh, 20%. I mean, 40% of consumer spending is done by the top 20% of the population. So yeah.
And Torsten Slok had a great chart out, and he kind of recycles this chart every once in a while over at Apollo, and it's basically those that have either no mortgage on their home or have a mortgage below 4%, which to that point just frees up all that cash.
Exactly. If your mortgage is at if you have a 30-year mortgage at 4%, you don't really worry too much about mortgages going to 7 or 8%. Now, if you're a millennial trying to be a first-time home buyer, your brain's going to explode. But for everybody else, it's really not as big an issue.
One of the names on your list is really interesting to me, which is Apple, because for the first time in a collective memory of a lot of investors, there's some serious and fundamental headwinds for Apple. And if you boil it down to one word, it's China. How do you guys get comfortable with that?
We get comfortable, but I think people underestimate the massive size of Apple. If you take a look at the App Store, that's an environment of 2.2 billion active users. Yeah. They've got 2.2 billion active devices that are out there. So that's 900 million people more than the entire population of China. Right. So sometimes when you think, okay, it's a China story, now it's a global story. If you take a look at the App Store, the total merchandise value that's traded on that is over $1.1 trillion. It's bigger than the Netherlands.
Yep.
So it's amazing how big it really is.
So I guess the issue there for Apple is, it's can they manage around China, number one, and I think there are a lot of people that are on both sides of that. And then number two, what is their AI strategy again? Do you think they're a tech company that has to have an AI strategy? Because they don't really at the moment.
I don't know. I think they have the luxury, but because they're so big, they have the luxury to take a little time to make sure it's right. Apple doesn't make many mistakes, and I think that they're really, to use a military parlance, they're really about ready, aim, fire. And so I think rather than jump into just anything AI, they want to get it right. And I think that's why people trust that brand. They trust the equipment. They trust all those things. So, the fact that they're not rushing in to be the exact leader on integration of AI means that they're going to try to get it right. And I think that that's going to be important.
Well, you mentioned Walmart earlier. We talked about that. What about Amazon? Why do you own a stock like Amazon?
Amazon gets about, 40 cents out of every dollar, 4 out of 10, of everything online. And so when you think about how massively large that is, and we have a consumer that's moving more and more online, if you move from, right now we're doing like 15% of retail is online, if they move to 25, which is kind of where most of the world is going, that's a $300 billion opportunity that Amazon has. And so as behavior changes and behavior moves more and more online, you're going to see greater use of Amazon. And one thing that we have to think about is on this inflation cycle. And even if you look at inflation, people being price conscious and things like that, the most efficient way to bargain shop is online.
Oh, you're preaching to the choir. Please.
And there you go. So it's just going to increase utilization of that platform. They're so dominant. And so I think that we find that long term, if we're thinking about this, that they're going to overcome whatever headwinds people are trying to imagine that they have.
One of the many reasons we like hearing from Walmart, and we will this week, is just it gives us a good read on the consumer. It feels like a broad-based read on the consumer. How do you view the consumer here? Because there's definitely some cracks out there for a lot of folks.
I think that when we talked about early on this trade down, right? If you break the consumer up into three groups, you have the top tier, the middle tier, and then the lower tier. The lower tier, inflation is showing up, and it's beginning to change some of their behavior. People having to pay more attention to pricing and things like that. They're going to move into more frequency of a Walmart or any of the discounters. But then when you take a look at that middle group, like I mentioned before, that trade down, where now because grocery prices are so high, people are going to move in there for grocery, and the next thing you know, they look at the rest of the store. And you hear it all the time when people say, "I can't find it anywhere else, so I went to Walmart." Mm-hmm. And so I think that we're going to continue to see increased traffic, and that's going to translate to increased growth and utilization. So,
but to the Amazon story, you're definitely buying it as a retail story, not as like a cloud play or an AI play. Is that just pony on a cake? What is that? Icing on a cake? I don't want a pony on my cake.
You don't want a pony on your cake. That could be a problem. But I think that
pony.
I think that it is. Amazon it's got the cloud, of course, and that's just going to continue to grow as we go through all this demand and AI and those things. But when we really kind of think about the consumer, because that's, what are people doing? That's a very solid growth story, and it's a behavior story of the American consumer. And I think that it's one that we really need to pay attention to, because remember too that pricing online has kind of gone down over the past 10 years, whereas CPI and everywhere else has gone up. So you get better competitive pricing online, better competitive pricing in an inflationary environment, and that's just going to continue to play right into that ecosystem that is part of. I've yet to find. I very rarely find somebody who hasn't bought something on Amazon.
Yep.
Yeah. And it just continues.
Yep, absolutely. And we'll hear from Amazon Thursday when we report their earnings. Walmart Thursday. Dryden Pence, thank you so much for joining us. Dryden Pence, he is the Chief Investment Officer at Pence Wealth Management, based out there in Newport Beach, California, joining us here in our Bloomberg Interactive Broker Studio.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, "Alexa, play Bloomberg 1130.
I'm Alix alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We bring you all the top financial and economic news through the lens of our Bloomberg Intelligence analysts. They cover 2,000 companies and 130 industries worldwide. And every Monday at this time, we dip into our Bloomberg NEF research team. So this is basically a research team that has the best data sets and models built by analysts and industry experts all around the world, and they cover everything commodity, power, transport, industry, buildings, ag related. And it's really on the cutting issues of our time, in my personal opinion, because you know how I like the whole green stuff, energy transition stuff. If you look at any report, they all quote the EV data that comes from Bloomberg NEF. And we have one of those individual analysts here with us now. Corey Cantor is being Bloomberg NEF lead U.S. electric vehicle analyst. It's great to have you here, Corey. Thanks for joining us.
Great to be here, guys. Happy Monday.
Happy Monday. We made it. So you your latest note is about how Tesla's recent stumbles, not necessarily government policy or anything like that, but Tesla's recent stumbles creates a door opening for the other EV makers like a GM and a Rivian. Can you talk us through what your latest research says?
Yeah, so if you look at last quarter, both globally and within the US, Tesla hit a bit of a rough patch. You saw globally sales down about 9% year on year. And when you're looking at the EV space and the automotive space, year on year is usually the best way to take a look at this market to see how things are changing and growing. And so when it comes to GM, when it comes to Rivian, Hyundai, and even Lucid, there's just an opening here for them to expand their market share. Each of them has a different strategy as it pertains to 2024. And this doesn't mean that either of them are any of them are going to pass Tesla in this year. But from years working in the EV space, all you would hear is we're always competing for number two. We can never surpass Tesla. And whether you're looking at the kind of EV car space or even EV charging, the fact that Tesla has taken a step back, both in terms of where they're focusing their sales, as well as their EV charging network efforts, it means that other people, if they are able to step up, can make inroads.
It feels like after an initial surge over the last 5, 6, 7 years that there's been a lull in demand for EVs. And I don't know, A, do you believe that's the case? And B, why is that, do you think?
So last year we saw in the US about 50% year-on-year growth for electric vehicles from 2022. So if anything, that was a really strong and successful year. We did begin to see some of the challenges around adoption as you move from that kind of early adopters phase to more of the mass market. And that's where consumers are going to be less patient with the technology and with the upfront cost, as well as charging infrastructure. And I think what makes the US different than other regions like Europe and China is that charging really hasn't been figured out to the same extent. And the heavy reliance on Tesla means that when Tesla steps back from charging investments, lays off many of the supercharging network team, it means it's going to be more of a uncertainty for the consumer here. So data in the first quarter, we're finalizing. We've seen a lot of data come up. Outside of Tesla, other automakers like Ford, Hyundai, Rivian all did quite well, but GM, Volkswagen, and Tesla took a step back, and that has a big impact on the market in the first quarter. We'll see how Q2 goes.
We are looking down the barrel here this week of some tariffs that will be imposed on China EVs imports into the U.S. Just knowing what we know about how these car makers operate and look at losses per vehicle when it comes to EVs, what would be better for Rivian and GM? Like more competition to kind of light a fire, or less that gives them more time to do stuff? Yeah,
that's a really good question, Alex. I think everyone that you speak to in the automotive space knows that the Chinese EV makers are out there, your BYD, and other brands. I mean, we even saw Zeekr last week.
Yeah, go public, right?
Yeah, go public. And so the pressure should already be there. Tariffs, you're not seeing really too many Chinese EVs really imported into the US. Volvo and Polestar might be the exception. But really what those tariffs looks like, I want to keep an eye on the battery portion, because I think that could have more of an impact than the couple or the thousands of EVs from China specifically, given that the battery supply chain is still very heavily reliant on China, particularly for those lithium iron phosphate batteries, LFP, which is used to help bring down costs in electric vehicles. For GM, GM is competing in China already, so they have a good sense of how competitive that space is. And really there you're seeing great technology and upfront cost at a low level, which eventually you'll see here. I mean, if anything, maybe the tariffs help stem the gap a little bit, but if you fall behind and don't invest in electric vehicles now, we could be having the same conversation in 2 to 3 years with those Chinese automakers aiming to come to the US.
So do we have a sense that the US OEMs, the Fords, the GMs, Stellantis of the world, have pulled back on their commitment to EVs, or maybe their timing of investments on EVs? Do you think that's happening?
I think the timing on investment in EVs is happening, right? In terms of their overall strategy, they've been, I think, approaching the market in a different way. Ford has been pushing towards this new EV platform that they're beginning to kind of produce in next year. GM, of course, has its Ultium platform. And for Stellantis, they don't actually have any fully electric vehicles here yet, although they have the highest selling plug-in hybrid electric vehicle, the Jeep Wrangler. A lot of this is on timing. But what I always like to say is that timing, and the investment is one thing, but you have to produce ultimately. And so if it's a delay of 6 months, a year, that's okay, but the cost of inaction gets higher. And if you really say, not just to the Chinese automakers, but other automakers like Honda and Kia really could make up a lot of ground here. And that's why there's such a big opportunity for Rivian to kind of step in. Ford and Tesla remain the number 1 and 2 EV makers here in the US. But they don't really have any near-term goals for 2024. And so when analysts are taking a look, trying to see what they're doing next, having a clear product roadmap could kind of clear up a lot of that uncertainty, and we don't have it right now.
When am I going to be able to buy a $16,000 EV that helps me go from here to the Berkshires without a charge?
You know what? I think there's a lot of interesting EV startups out there, and you seem pretty well attuned. I think we're going to see starting next year more EVs kind of coming down to the low $30,000 price point. The big question is how many of them are going to have that $7,500 tax credit, and of course, there's a lot of policy questions, and then an election this year that'll have an impact on that too.
My takeaway is not yet, Alex. Not yet.
Couple years.
Yeah. Corey,
there's
thanks
the
a lot.
Seagull. The Seagull is $10,000.
Now I'm going to look at this thing. All right.
Yeah, right?
It's BYD's.
But that's the whole point. That's BYD.
Okay. Well,
That's Chinese.
Yeah, and that car is about $20,000 in Mexico, so the $10,000 I think is
maybe not the price that I would be paying. Maybe
only one
more.
windshield wiper.
Huh.
How many do you need?
How does that work? I mean, to be fair, do the two really make a difference? Corey, thanks a lot. Corey Cantor, Bloomberg NEF, lead U.S. electric vehicle analyst. But if you put 100% tariff on that, how much is that going to cost me?
Yeah, that's not going to help.
But if I could get a $10,000 one, that can get me from here to the Berkshires with one charge, I would definitely consider something like that.
Yeah,
this is why the
that'd
policy
be great,
confuses
great
me.
in the snow up there in the Berkshires.
Oh, that's right. They're real cold.
Yeah.
All of a sudden, you have to walk home. Take you 17 days. It's just basically the batteries don't work that well in the cold. They got to figure that one out. All right, thanks a lot, Corey. Really appreciate that. This is all the pressing stuff that we get you here on Bloomberg Intelligence and Bloomberg NEF.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
All right, last week I was visiting our good friends at Boston Consulting Group, BCG, up in Boston. I attended the Boston Consulting Group Edge Expo in Boston. I had a lot of great conversations with executives at BCG. One was with Sesh Iyer, North American co-chair. He focuses on helping clients think through the levels of value for new artificial intelligence and the role of AI moving forward. I began by asking him to tell us what he thinks AI is today. Let's listen.
So we are really looking at how we can really leverage technology, and when we say intelligence, being able to really interpret data, apply data to really drive change, to create value inside of organizations. It's how do you take the data, apply it against processes to really get rounds of value around either productivity, around cost, around top line, around customer impact, around customer intimacy and delight. So how do you essentially use data to generate that insight? So in a simple way, that's what AI is about. A lot that we are clearly observing right now is also not just predictive AI, which has been around for a long time, but the emergence of generative AI that then adds, 4 specific things. The first is the synthesis of information and large reams of information. How do you synthesize and get the right information in the right construct to the right person? There's a lot around generation. We actually can generate not only text, but we can generate voice, we can generate videos. The third is it's very conversational, right? So you can actually engage with very low friction. And then the last is it has the ability to reason. So it can actually have a good dialogue with you. So we are starting to see these additional attributes in Gen AI that are actually bringing a lot more value front and center.
It's interesting. I think there was, Bloomberg ran a story a quarter or two ago. Every company in the S&P 500 on their earnings conference call mentioned AI. It has come out of nowhere. How receptive are your clients to discussing AI, making the investments in AI, whether that's upping their technology budget, reallocating their technology budget? How do those discussions go?
So we did a survey earlier this year. We are clearly seeing 70% of execs increasing their spend. And then within that 70%, we are seeing 50% of execs say that Gen AI is going to be a top priority. So we are clearly seeing more investments going against leveraging this to deliver to value. Now that being said, the other thing that we are also observing is there's only 1 in 10 executives or companies that are truly pioneers.
Okay.
Right? The other 9 in 10 are, I would say, doing a wait and watch. But what we're really observing that are amazing characteristics in these pioneers, one is they are massively ambitious. They truly see the potential of the technology. They want to get the value from it. They're investing in it. They're very business value driven. That's one. And their ambition, what we observe is anyway 1.3 to 1.5 times the ambition of the folks who are not investing. The second is we clearly see upskilling and reskilling to be center of their focus. 46% of people will need to be reskilled.
That's a big number.
It's a big number. It's a big number in organizations. You think about organizations that are 50,000, 100,000 people, you're talking about thousands and thousands of people that need to be reskilled. Also related to that are senior executives. 60% of senior executives need to be upskilled. So they know how to be good sponsors to actually apply the technology. The third thing is intimately understanding costs. I mean, many folks understand direct costs. Indirect costs are still not fully in the equation, so understanding the cost profile of what this takes, not only on the build, but also once you deploy to operate it. The fourth is partnerships. Are you truly engaging the right partners in your ecosystem? Because this is not a one partner solve, this is a multi-partner solve. And then the last thing is, which is very important to us at BCG, is leading with responsible AI. You can apply the technology, there are a lot of downsides to it, how do you put the right controls in place?
If you come into my office, or when you come into my office and really make the case that I need to invest in AI, I'm going to ask you, okay, but is it going to make me better? Is it going to make me more efficient? Because I'm going to have to up my tech budget. You just explained to me how I'm probably going to need to up my tech budget over a long period of time. What's the payoff for me from a P&L perspective? Can you make that ROI case?
Yeah. So there are 3 pathways to value that we observe. The first is what we call deploy, where existing solutions already have GenAI features. So if you think about Office 365 Pilot, or you think about GitHub Copilot, or you think about Zoom, the video application that can generate a transcript from a call, it's turning on those features. And you can start to see value that's 10 to 20% there. The second pathway is what we call reshape, which is driving end-to-end transformations of specific functions. You think about the marketing function, you think about the finance function, or you think about the customer service function, or let's say the underwriting process in an insurance company. That's 30 to 50% in terms of not just productivity unlock, but in terms of speed of performance, in terms of value delivery that happens to the customer that's at the end of that process. And then the third thing that we're observing is what we call invent, where it's completely new business model. So you think about creating a new beauty assistant, or you think about creating new molecules. We recently, on the invent side, we have now done a longitudinal study where AI-generated molecules have 2 times the success coming out of clinical phase 1 trials compared to molecules that were created in the lab. That's amazing, it is, right? And you think about ROI there. I mean, the ROI is so obvious. So we are seeing specific sectors and specific functions really go through massive change.
I think most people, as they come up the AI curve and just understanding, are concerned about responsible use of AI, the risk to AI. Will AI take over the world? Will the machines take over the world? How do you frame that risk out, and what do you suggest to your clients?
So one of the things we tell our clients is clearly there's so much of value when you adopt this technology, but you have to do it in a really responsible way. So what is your responsible AI framework to put against it? What is your responsible AI strategy? How do you really think about responsible AI governance? What are your lines of defense? How do you actually implement the right structures in place? When you think about processes, your product development process or your portfolio monitoring process, how are you really including responsible AI in it? For example, when you're building GenAI solutions that have LLMs in the middle of it, are you really doing proper verification and validation to ensure that LLMs perform to your objective function and they don't start doing something you don't want it to do? Do you have things in place for that? So there are a number of these different pieces of the entire responsible AI framework. So we have a comprehensive framework. We lead with that at our clients. And it is a capability build. So just like you have a capability build around risk and compliance, there is now a capability build around responsible AI.
Interesting. I know at BCG you have the 10-20-70 view.
Yeah.
What is that?
So when we think about truly driving transformative change with technology at the core, our 10-20-70 is 10% is the algorithm, 20% is the data and the technology components, and 70% is the change management, the process re-engineering, the adoption of the technology. So to drive real value, you need all 3, right? Many organizations, I would say, focus on the 10 and the 20, but not fully focus on the 70. And we lead with the 10-20-70 that really drives. So we deliver, I would say, impact and outcomes, not systems.
Right. So, I mean, it sounds like in order for a company to really champion AI within their business, the commitment has to be from the board to the C-suite, down all the way through the organization, because it sounds like, A, it's a big financial investment, but B, it's a little bit of a different way of thinking about your business. How do you achieve that?
I think it goes back to, if you think about the unbroken chain of why does the company exist? What value does it add to its customers? What value does it add to its employees? How does it contribute to society? If you really unpack the why, I think this does need to start at the top. So what is the competitive differentiation that technology or GenAI can drive for an organization. It starts from there, and that is a CEO level point, and then it migrates into what does it do for my customer, what does it do for my product, what does it do for my processes, what does it do for my employees. All of that then follows through. Right? So if you think about value, customer intimacy value, we have a car manufacturer that has integrated Gen AI into their cars. They sell 2 million cars a year. That is changing the way in which consumers experience their product. You think about product lines. Google recently came out with Google Vids, where you can actually now create videos on demand. The marginal cost of creativity has dropped substantially. Yep. You can build not only images, but you can build presentations, you can build videos. It's so easy to do it. You think about process excellence. We already talked about software development. You have a large, financial global bank that is looking to improve productivity by 30 to 40%. I mean, these things are real. And I think the CEOs clearly know that they can drive differential competitive advantage across all of these different dimensions.
What's the biggest pushback you get from your clients about this? Is it the cost? Is it I'm just technology, concerned about technology? What's the pushback you get?
I think the biggest thing that we see, if I think about CEOs, their entire focus is on how can I get to this value fast, right? So is it going to really change the trajectory of my business? Talk to me about outcomes that I can deliver to. So when we think about the three dimensions of what really matters to these folks is, can I deliver outcomes at scale? Don't talk to me about an experiment, talk about it at scale. Can I combine Gen AI with predictive AI and other technologies, automation? Show me the end-to-end, not just the one sliver of this. And then I think the third is the 10-20-70. A lot of folks lead with, this is such cool technology, but can you really show me the impact? Will my people be better off when they adopt the technology? That's a big part of what we see. So I think those are the three things: outcome at scale, predictive plus generative AI plus automation, and then the third piece is the 10-20-70.
All right, that was my conversation with Sesh Iyer. He's a North American co-chair of the Boston Consulting Group, talking about AI. We were up at their Expo conference up in Boston last week. I'll tell you, AI, it was front and center as BCG talks to their clients. That's what the CEOs want to talk about. They want strategy about how to invest and when to invest and how much to invest. So it was good to check in with some of the smart folks at BCG.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.